Welcome back, everyone. Today on the Joseph Carlson Show, the legendary billionaire Paul Tudor Jones gives a stark warning about artificial intelligence. Apparently, he went to a meeting with all the brightest minds in AI, and they discussed how AI will potentially kill half of human civilization. No, that's not an exaggeration. We'll be looking at that, as well as many other predictions, or rather warnings, that he gives about artificial intelligence. At the same time of these grim warnings being given by Paul Tudor Jones, we have the legendary investor Howard Marks going on to CNBC, explaining that the market is now in a state of limbo. It's in a state of paralysis, or we're in a waiting game, waiting for what's going to happen with the tariffs. We'll be going over his interview. And then we also have some viral tweets. This is one that I put out yesterday. I said I genuinely believe that we're at a point where many retail investors are more educated, have longer term perspective, and a deeper understanding of the stocks they own than institutional investors. Now, like you'd expect, this type of claim created a lot of debate, a lot of arguments, a lot of people saying, how can that be? Aren't retail investors the dumb investors? Well, this tweet was after an appearance from our very own Amit from YouTube on Bloomberg. He made his first TV appearance, and I want to go over this and just kind of review the appearance. He is, after all, a YouTuber, and we're seeing the convergence of YouTube with traditional TV. We're seeing the convergence of the retail investor versus the institutional investor. And we'll be looking into this subject more in this episode. Now, we also have more negative news for Google. This is another shot at this company. Apparently, under testimony, Apple has been working to move to AI search in browser amid Google fallout. This news is not good for Google, and it gets even worse in the headline. The stock has fallen 7.7% today. We'll be diving into this report and highlighting what's going on between this relationship of Google and Apple. And then finally, we have news that Uber reported their earnings. They missed on revenue. The stock is down a little bit, but it's recovering. We'll be discussing the earnings. So as always, we have a ton to get to in this episode. And we start things off by looking at this rather viral interview of Paul Tudor Jones. He is a legendary investor. He's a trader. He's a billionaire. And he describes how he went to this meeting with all the brightest minds. He says that they're household names. And in this meeting with all of these incredible people, they had discussions of how threatening artificial intelligence is. Let's go ahead and listen to him describe his experience in this meeting.
Than you are about artificial intelligence. What do you mean?
Well, let me just say, I was minding my business. I went to this tech conference about 2 weeks ago out west, and I just want to share with you what I learned there, Chatham House rules, so we can talk about the content. So it was a small one, 40 notables, but real notables, like household names that you would recognize, the leaders in finance, politics, science, tech. And they had a variety of panels. I was on one on capitalism. And there was a tech panel that had 4.
These meetings that they go to, like 40 notables, household names out west, like these are the secret billionaire meetings, like just secret meetings. They're in some loop or some circle that no one else is privy to, none of us know about. It's just all the brightest minds that they congregate together, and they have these secret meetings and they discuss stuff. And here he is spilling the beans, explaining what's going on.
Of the leading modelers of the AI models that we're all using today. So it'd be persons 1 through 5 of each of those 4 models. And the quick 3 takeaways from that are, 1, wow, AI can be such a force for good. And we're going to see it immediately in both health and education very quickly. It's going to be fantastic. That's the good news. 2, the neutral news. These models are increasing in their efficiency and performance between, on the very low end, 25%, on the high end, 500%, every 3 or 4 quarters. So it's not even curvilinear. It's a vertical lift in how powerful artificial intelligence is becoming.
Right.
And then thirdly, and the one that disturbed me the most, is that AI clearly poses an imminent threat, security threat, imminent in our lifetimes to humanity. And that was the one that really got me going.
When you say imminent.
So he says AI is going to be a force for good in healthcare and all these applications. The technology is getting a lot better, a lot faster. but now it's an imminent threat in our lifetime to human civilization. Now, up until now, I've heard arguments, I'd say, about this kind of theoretically, and I've also heard arguments, of course, that I think are very valid, that AI is going to be a force for good and a force for evil. This is something that all of us intuitively know. We understand that AI is going to have incredible efficiency gains. It's going to make work and progress and creating products better. It's going to revolutionize different industries. It'll create more wealth for civilizations, more wealth and efficiency. Efficiency is the foundation of wealth. Wealth increases people's lifestyles. So artificial intelligence is going to be a massive good in terms of benefits for society, but it is a huge and sharp double-edged sword. There's going to be fraud. There's going to be enormous amounts of financial schemes that people do with artificial intelligence. There's going to be all sorts of lies, fake videos of people. The amount of misuse of AI is incredible as well. But he goes even a step further, talking about how it's not just going to be used for fraud and deceit and, all these different security issues. It is an active threat to our very nature, our health and our existence.
Threat, what do you mean?
So I'll get to it. So they had a panel of again, 4 of the leading tech experts. And kind of about halfway through, someone asked them on AI security. Well, what are you doing on AI security? And they said the competitive dynamic is so intense among the companies, and then geopolitically between Russia and China, that there's no agency, no ability to stop and say, maybe we should think about what actually we're creating and building here. And so, and the follow-up question is, well, what are you doing about it? And he said, well, I'm buying 100 acres in the Midwest. I'm getting cattle and chickens, and I'm laying in provisions.
For real?
For real. For real. And that was obviously a little disconcerting. And then he went on to say, I think it's going to take an accident where 50 to 100 million people die to make the world take the threat of this really seriously. Well, that was a freaky deek to me, and no one pushed back on him on that panel.
One of these guys, these tech experts, gets up and says 50 to 100 million people are going to have to die before people take this seriously. So this is the type of stuff they're discussing in their secret, expert genius, best AI modelers, billionaire meetings, the secret meetings they have. They're discussing how parts of civilization will be wiped away by the technology that they're creating. And that's their big concern. But again, this continues on, and I think it even gets worse from here. You're probably thinking that this is already pretty bad, but it gets worse.
And then afterwards, we had a breakout session, which was really interesting. All 40 people got up in a room like this, and they had a series of propositions, and you had to either agree with or disagree with the proposition. And one of the propositions was there's a 10% chance in the next 20 years that AI will kill 50% of humanity. So there's a 10% chance that AI will kill 50% of humanity in the next 20 years. Agree or disagree? So I'd say the vast majority of the room moved to the disagree side.
That's a little reassuring on their, in their discussions when they're discussing the odds of 10% of humanity, or 10% odds that 50% of humanity gets destroyed by AI in the next 20 years. The vast majority of them disagreed. So I think that's a bit reassuring. The brightest minds don't yet think that there's a really good chance it's going to destroy half a civilization. Now, there are still some that believe that, according to Paul here.
I had just heard Joe Rogan and Elon Musk 2 months ago, where Elon Musk said, there's only a 20% chance that AI can annihilate humanity. Now I know why he wants to go to Mars, right? And so about 6 or 7 of us went to the agree side, and I'd gone there because of what I'd heard Elon Musk say, who's maybe the most brilliant engineer of our time. All 4 modelers were on the agree side of that. All 4 of the leading developers of the AI models were on that side. And then we debated. Then the 2 sides got to debate. And one of the modelers says to the disagree side, if you don't think there's a 10% chance, as fast as these models are growing, and how quickly they're commoditizing knowledge, how easily they're making it accessible, that someone couldn't biohack, because that's where the real weakness is. A weapon that could take out half of humanity. I don't know. 10% seems reasonable to me.
Okay,
so there we get Paul Tudor Jones' real concern: artificial intelligence, the threat to humanity, biohacking. He's asked about the markets, and he says that that's really not on his mind. It's not the thing he's concerned about. He's concerned about these issues with AI. Now, on this subject, it is true, and theoretically it seems realistic, that artificial intelligence could be used to create some biohacked disease, cause a lot of damage. All that type of stuff is a threat. But those type of threats have existed for a long period of time. Generally, what we see every time there's new technology that's disseminated and distributed across different civilizations and people is that on the verge of it being distributed, people are nervous about it. They consider it a threat. Almost every new technology is considered a threat to people at the beginning. And in most cases, the big majority of cases, artificial intelligence raises living standards. It does more good than bad by a long shot. That's the case with the internet. That's the case with electricity. That's the case with everything that you can basically name off. That's the case with technology that's distributed to everyone. I believe the most important part of AI is making sure everyone has it, that everyone has access to it. I believe the most damage that can be done is only if a few parties have access to it and nobody else does. That leaves a lot of power in some people's hands and none in others. But if it's a technology broadly distributed like the internet, that the whole world basically has, then there's ways to combat and deal with the downsides. For every fraud, there's ways to detect fraud. For every virus, there's ways to cure it. We can use the same tool to combat the downside. And right now, what I see is a healthy level of competition where artificial intelligence is going to be in the hands of virtually everyone. Now, we also have Howard Marks, another notable billionaire, explaining that he's focused more on the markets, and right now, his focus is on this waiting period. He describes it as being in a state of limbo.
But I still think that there's going to be a significant period of uncertainty. I've never negotiated a trade deal. They say it takes a long time. We still have roughly 2 months to go before the pause is over. Maybe that'll produce conclusions. Are those conclusions going to be permanent or temporary? So I think that the world is more uncertain than it used to be. I think the stock market is full of people who are constitutionally optimistic, and they've taken the opportunity of the relenting on tariffs to reassert their optimism.
Howard Marks is right. Right now, we're just in a waiting game. I said before that the bull case going forward in this market is the trade deals being announced, that the U.S. has made trade deals with foreign nations. And once we have the first one, that'll be a big day for the market. Then we'll have the next one and the next one and the next one. Like dominoes, the market will have renewed optimism with every incremental trade deal. That's how I envision this market moving up. But so far, we haven't even had the first one. This is what the market is waiting for. The first actual trade deal, and not one just being talked about potentially in the future, or we're getting close, or we have great progress. No, actually having a real trade deal being signed. We need to see that, and so far it's becoming a little bit discouraging that it's taken this long. I would assume that even with these complex trade deals, we would have at least one by now with one partner, but it's just taking a little bit longer than expected. So hopefully we get those before the end of the 2 months. I believe if we don't get a single trade deal before the end of the 3-month period, the market will go lower. Now, moving on, I want to address the reaction I received to one of the tweets I sent out yesterday. This one was about how I now believe that we've reached a point where many retail investors are more educated. They have a longer term perspective and a deeper understanding of the stocks that they own than institutional investors. Now, as you would guess, there's a lot of debate and arguments about this. Many people believing that retail investors really aren't anywhere close to institutional investors because retail investors did dumb things here or dumb things there. And people can cite examples of that. But that kind of misses the point. The point I'm making here, like the tweet says, is that there are now more and more retail investors that have higher quality research, better tools for analysis, and they have longer-term, deeper understanding of the companies that they own than institutional investors. And in many cases, they're way ahead of institutional investors in many of the best stocks. An example of this is a recent appearance I'll highlight from Amit Kukreja. This person is a retail investor. He's a fellow YouTuber, one of my peers. And here he is on Bloomberg. So he made the journey all the way from YouTube, do it yourself, retail investing, just talking with other people in his community, to now being highlighted on Bloomberg. And this section from Bloomberg was a response to Palantir's earnings. They had basically a section where they brought on a retail investor because it has a big retail following. And the interesting dynamic here is that I believe that what they kind of expected here was the retail investor to be silly, to be a little bit, naive, to not really know too much about the company except for they want to pump it and rocket emojis. That's the feel of what's going to happen when you bring on a retail investor. But what I want you to do, and I'll play a couple clips here. I want to highlight some of this. And what I want you to do is just listen to the quality of commentary, the knowledge of the company, and his remarks, and compare all of that quality compared to the average institutional commentator that comes on the CNBC. Compare the two.
Of AK Media, about 250,000 followers you got across YouTube, across X. You are very popular for your thoughts on the stock among what, Dr. Karp himself has called a retail army. What did you make of the numbers today?
Hey, Carolyn, thanks for having me on the show. I've been covering the company for the better part of 5 years now, and I've been joined with a very passionate retail investor base. And there was something that retail saw in this stock when it was trading in the single digits that Wall Street did not see. Obviously, we've seen what has happened since then, and now Wall Street is buying it at a higher premium, but maybe that's because it deserves a higher premium. I mean, you're talking about a company that just did 39% year-over-year revenue growth, 71% U.S. commercial growth. The remaining deal value is up 127%. Their U.S. government business is now accelerating to 45% year-over-year growth. It's a company doing $900 million in revenue, nearly $900 million, with less than 800 customers. I know the valuation's aggressive here, but I think the growth is starting to warrant it.
He has all the numbers, doesn't need a teleprompter, doesn't need to have a device in front of him. He has all the numbers off the top of his head there. Very knowledgeable about the recent growth of the company, the growth prospects, acknowledges the valuation looks a little stretch, but highlights that Palantir is a one-of-a-kind company. It is growing far faster than most companies in the market, and it is solely in artificial intelligence. So people are paying a premium for it. Now, again, this interview goes on, and there's a series of questions being asked here, and I just want to give you another highlight of the type of quality response you're getting from a retail investor.
Interested in your take, perhaps from some of the analysts out there. Jeffrey's saying, look, this is really a retail trade. I'm not hearing people talking about Palantir in the institutional market in any way the same amount that we're hearing in the retail community. Is that retail resilience there?
Well, if you look at the institutional and retail ownership split, it's 50-50. So this is not Tesla in 2019 where it was 70-30. I think there's a 50-50 split. So there's obviously institutional investors that are excited about the name. But in terms of the valuation, let's take a second and step back. OpenAI is worth $300 billion on the private markets, and they're not even profitable. AIG said this a month ago at their investor day, and Palantir quoted this in their slide deck in their earnings yesterday. AIG expects the adoption of an AI-powered underwriting solution leveraging AIP, Palantir's core software offering, to double its 5-year revenue CAGR from 10% to 20%. Alex Karp, the CEO of the company, has been saying that large language models largely are becoming commoditized. The implementation of them is what matters. I'm not saying the stock is cheap. I'm saying the aggressive obviously is the multiple is aggressive, but it might be warranted because the implementation of AI is what really matters, and Palantir is delivering those results.
When I look at the quality of response, the knowledge of the business, I don't believe there's any institutional investor that could go against Amit on this subject. Frankly, most institutional investors look at some analyst report on it, they have a buy rating or a sell recommendation, and that's about the extent of knowledge. And they also have 2 to 3% positions on companies like this. Retail investors that have this in-depth, deep-level knowledge on the business, making a bet on the company when it's $7 per share, watching it go past $100 per share, and then we have the media saying, well, isn't it expensive now? And that's true. Palantir is an expensive stock. It's optically very expensive. But that's the same type of concern that we hear institutional investors and different people say at widely successful stocks, companies that have already won. It's the same thing I hear all the time from Costco. Isn't the stock expensive? Why do you own such an expensive stock? Well, I bought it much lower. I bought it before institutions were piling in. When you bought Costco at $300 per share, you're not concerned of whether or not it's 800 or 1,000. It doesn't really make a difference. When you're so widely in the green on a stock because you bought it at a time period way above when the institutions even caught notice, you're not as concerned about the valuation. And like most good long-term investors, you continue to hold a company so long as it's performing. I believe that you could put people like Amit, someone that's studied this company for years, that's made significant bets, that knows every single thing about the company. You could put him against, I think, any institution. I think he'll be able to go toe-to-toe, if not debate and know more about the company than most institutions. They have their Bloomberg terminal, but that's not knowledge about the business. That doesn't tell you all the intricacies and qualities of the company. Getting a feed line of the latest news on the company is not fundamental research. So what retail investors are doing, like Amit, is far more important than what many institutions are doing. Now, of course, I'm talking about Amit here, but I'd also put my own research against any institutional investor any day of the week. We can go back to examples like 2022. I did an interview with Amit on his channel. At the time, his channel was much smaller. It's got like 5,000 views, so you probably haven't seen it. But this highlights the quality of research done by retail investors at this time. In this same interview, Amit goes over his thesis on Palantir. He says why he thinks it's a great buy. Palantir was like $20 per share. So it's gone up 5x since this interview. It's one of the best buys in the market at the time of this interview in 2022. And at the same time, I go over my thesis in Netflix and I list my buy target. At the time of this interview, Netflix was $300 per share. I look at it and I did some discounted cash flow analysis on it. My estimation is that they'll make around low end of $30 of earnings per share in 2025. That was my estimation on it. So I think they'll put it at like $950, around $900 a share. But that's my estimate.
It's massively undervalued. That's what you're saying.
Yeah, I think so. I highlight that I think it's massively undervalued. Again, Netflix is at $300 per share. Now it's at $1,160. Amit highlights his stock, which is Palantir, which was, I think, $18 to $20 per share. Now it's above $100. These are two of the best stocks in the market being discussed by retail, while institutions wanted nothing to do with them. So sure, we can all find examples of retail investors doing silly things. We can all look at the financial TikToks of them taking huge amounts of risk. But that's not what I'm talking about here. What I'm talking about is there's an emerging trend of quality investors that are retail investors, doing real fundamental research, having long-term perspectives, having extremely high quality insights and perspectives on companies far in advance of institutional investors. And even the tools that we use now are becoming more and more powerful. The Bloomberg terminal was a huge moat for institutional investors. It gave them a big advantage. It had all this financial information. It had all this nice, concise financial information, but it cost thousands of dollars per month. Now we have tools like Qualtrim. I have all the fundamentals of each company. I have all the KPIs. I have nice summaries of the earnings transcripts. I have discounted cash flow tools. I have a news feed in it. I have every single thing I need to make good judgments on a company. And now we have that stuff for like $10 a month, not $2,000. So what I see is a big opportunity here for retail investors to have victory over institutional investors. In many ways, this is like what Peter Lynch talked about. He always thought that retail investors have an edge over Wall Street. He always thought because of their unrestricted nature, their ability to be more concentrated, their ability to change their mind immediately, the fact that they're not beholden to shareholders or investors, they don't have to advertise and have assets under management, gives them an inherent edge. The fact that they work in certain industries, and that can lead to specific insights that the analysts pounding away on a keyboard in Wall Street don't have. So I see this trend continuing, and I think it's going to get bigger and bigger. Right now, I believe this is the convergence of where retail really starts to outperform institutions. Now, we move on with Uber's earnings. They just reported earnings this morning. It says in the headline here that Uber misses revenue expectations with trips up 18% year over year, or over last year. It sounds pretty negative. The headline sounds negative. Uber is down around 5% this morning. It's being bought back a little bit. It's now down around 2%. And again, the headline gives kind of a negative vibe to this, but overall, the earnings are just great. These are great earnings. If we look at what they actually did, earnings per share was 83 cents versus 50 cents expected. So they miss a tiny fraction on total revenue, something they don't have as much control over. That's just the amount of volume and rides. But they have more control over their operating leverage, their execution, their cost control, and they crush it with their earnings per share. The CEO, Dara, says that they're still growing gross bookings, meaning more people taking trips. Now, they announced that the FTC has sued Uber and accused the company of deceptive billing, which the CEO replied to saying, quote, "It's a bit of a head scratcher for us." He says that the suit alleges that some people don't realize that their signing up or cancellations are difficult, but I'd encourage you to go experience it yourself. It's very, very simple. You take a couple of steps to be able to cancel it if you want. This is the perfect response. If the suggestion is it's difficult to cancel, then the CEO would want to try to hide it. But instead he's saying, just go try it yourself. Try to sign up and cancel. It takes a couple of seconds. It's super simple. I think that's the perfect response from the CEO. He's basically calling their bluff, saying that right now you can go and cancel. It takes a few seconds. Now, in terms of growth of the company, it's still a fast growth company. Mobility grew by 13%, delivery grew by 15%. Also importantly, the monthly active platform consumers, basically the amount of people that are using the application, had grown to 170 million, up 14% year over year. This is growth all around, growth of the application, growth of the amount of trips they're taking, both in food delivery and in ride sharing. I don't believe the stock deserves to trade down after these earnings, and I wouldn't be surprised if tomorrow we see it right back where it was. Now moving on, we get to some more disappointing news about Google. And this one seems rather serious. This is reported from Bloomberg. Apple is working to move to AI search and browser amid Google fallout. Not a great headline if you're either an Apple investor or Google, but I'd say especially Google. I don't think this is quite as bad for Apple. When we look at this, it says Apple is actively looking at reshaping the Safari web browser on its devices to focus on AI-powered search engines in light of a potential fallout of its deal with Google and the broader industry shifts. Eddie Q, Apple's senior vice president of services, made the disclosure Wednesday during his testimony in the U.S. Justice Department lawsuit against Alphabet. So this is the type of stuff that's normally internal, like we would not know about this, but it's now being drudged up and exposed because of this lawsuit. So if you're not aware, what's going on right now is Google's paying Apple $20 billion a year to be the default on Safari and on their device. So when someone buys a new iPhone, they by default have the Safari app. When they open up the Safari app, by default, they have Google search. And Google loves that because it makes them more ubiquitous, it makes it less friction for the user, and of course it doesn't open up the opportunity for them to jump to ChatGPT or for them to jump to a different search engine like Bing. Now, this Apple executive also noted that searches on Safari dipped for the first time last month, which he attributed to people using AI. There's a lot of things that you can say are just headlines and, headline news, and it's things that you can kind of ignore. This is not one of them. This is something that's actually meaningful to Google. We are seeing real evidence here that search volume is dipping in Google search. The first time that I've actually seen this type of news show up from a trusted source. This isn't rumored. This is in a court. He cannot lie about this stuff without facing prosecution. And he says that this is the first month they've seen search volume dip. And his reasoning behind it is he just thinks more people are using AI. So out of all the times we talk about Google and how it's not shown up in the data, that has changed as of today. This is the first data, again, that I've seen that search volume is actually decreasing with certain distribution partners, especially one as important as Apple. Now, he again said that he believes that AI search providers, including OpenAI, Perplexity, Anthropic, etc., will eventually replace standard search engines like Google. He said he believes Apple will add those players as options in Safari in the future. Now, of course, Google has a different opinion of this, but Apple's making their position clear. They are concerned about the strategic position that Google Search has in this distribution. And obviously, Apple is a significant and important distribution partner with Google. Otherwise, they wouldn't be paying them $20 billion a year. So again, this is one of the most bearish outlooks I've seen on search. It goes in the face of what Google's saying, where they say search volume's growing. AI adds to the search pie. It doesn't subtract from it. Apple's basically saying that they see more overlap in this. They see actual AI taking away a big part of the search pie. It's not just some overlap, they're seeing a lot here, and they believe that it's actually going to replace it. He says, quote, "We will add them to the list. They probably won't be the default." He said, adding that they still need to improve. Q specifically said the company has had some discussions with Perplexity. Right now, Apple offers OpenAI's ChatGPT as an option in Siri and is expected to add Gemini, Google's AI search product, later this year. So Apple's taking the approach of now just becoming, you kind of select from a list. Like, they're not having these relationships. They're just letting users select whatever AI, LLM, whatever product they want to use. It's no longer just Google search. It's now being broken up and sliced with all these different options, and Google really doesn't have the same dominant moat with Gemini that they had in search. Q also said that the large language models, the underlying technology for generative AI, will continue to improve, giving users more reasons to switch. Now, both the stocks are reacting in a big way today. Google's down around 7.5%, Apple's down a couple percentage points, and this is the first point where I've actually seen real news, real solid data that we're seeing an impact in Google search volume. And that's the most concerning part of this entire report. This line right here. He noted that search on Safari dipped for the first time this last month, which he attributed to people using AI. And this is the thought process I continue to have with Google. There's so many great parts to this company. You have Gemini, you have their artificial intelligence, their leading models, you have the cloud computing and their cloud business growing strong, you have YouTube, and you have Waymo. All great properties, but they make up roughly half of their total revenue. The other half is by revenue based on search. And if search volume is truly declining, that puts that business line at risk. And it's difficult to understand or at least do analysis on how much overlap there is between ChatGPT and Google search, how many people will truly leave and stay. It's becoming more difficult. And every time I look at the complexity of the business and half their business line being under threat by LLMs or ChatGPT, as well as the ongoing lawsuit with Chrome, and the fact that it seems like that's becoming more likely, it makes Google just more of a headache. A company that I wonder if it's worth the headache. The constant news, the constant iterative worsening of fundamentals and the moat, the distribution of it being challenged. And I look at Amazon as an alternative. I've made this point many times, but I'll make it again. Both Amazon and Google are down substantially from their all-time highs. Amazon was at 240 and now it's at like 180 or 190. Google is at 200 and now it's at 150. They're roughly both down the same amount from their all-time highs. They're both intrinsically deeply undervalued. But when I compare Amazon and Google qualitatively with the amount of risks they face, I continue to believe that Amazon may be the better bet. Not because it has more upside. I think that Google has potentially a lot of upside, but because Amazon doesn't have these same big questions that concern investors, that create this constant headache. Amazon is not being sued by the DOJ and having part of their company under threat of being sold. Google may have to sell Google Chrome, which will impact Google as a business. And Amazon is not facing some potentially existential threat with LLMs. Now, again, I don't think that Google will be hurt by LLMs ultimately. I think there's a chance here where they grow, but it is still a question. With Amazon, there's no question there. With Amazon, simply, I believe right now the story is just cleaner. It's a cleaner path to victory. There's less intrinsic value questions, less terminal value risk. Amazon, like Google, has its foot in all these major technological innovations. They have advertising just like Google, but their advertising business is not under threat. There's nothing right now that is really threatening to Amazon Retail and their sponsored links or Amazon Prime Video. Those businesses are business as usual. Amazon is also in cloud computing. They're also in the AI game with AI models. They're also in content creation with Amazon Prime Video and Twitch. They're also in robotaxi networks with Zoox. And Amazon is in a few other businesses that Google currently doesn't have, like Project Kuiper with satellite internet. So it's an equally exciting business in my mind as Google. But I just think it misses out on a couple key questions that Google has. And when we get news like this, that Google's losing search volume in Safari as testified by an Apple executive because of artificial intelligence, it makes me wonder if this company is worth the headache, or if it's just easier to go with Amazon, which has a lot of the same benefits and seemingly fewer risks. It's a trade that I've been considering. I want to know your input. Let me know what you think. That's going to be it for this episode. See you in the next one.